Warren Buffett is hoarding $325 billion in cash. That's $325 billion sitting in treasury bills earning 5% doing absolutely nothing else. No stocks, no acquisitions, no investments, just cash. That's 30% of Berkshire Hathaway's entire value, the largest cash position in the company's 60-year history, larger than the GDP of Finland, larger than the market cap of Netflix or Adobe, just sitting there. And here's what nobody's telling you. Buffett has done this exactly twice before. Both times, right before the market crashed. Both times he deployed at the bottom and made tens of billions. In 2007, Buffett held $40 billion in cash, the most he'd ever held at that time. Everyone said he'd lost his touch. He was too conservative, missing the boom. Then, October 2008, the financial crisis hit. The S&P fell 57%. And Buffett deployed his cash into Goldman Sachs, General Electric, Bank of America at crisis prices. He made over $20 billion in those investments. In 2019, Buffett held $120 billion in cash. Again, the largest position ever at that time. Analysts criticized him, said he was sitting on the sidelines while the market made new highs. Then March 2020, COVID crashed the market 35% in 3 weeks. Buffett deployed into Japanese trading houses, Occidental Petroleum, and other positions at 40 to 50% discounts. Those investments have doubled or tripled. There's a pattern, a three-stage pattern Buffett follows before every major crash. And it's not prediction. It's not market timing. It's mathematical. When valuations reach extremes, when risk-reward becomes terrible, Buffett moves to cash. He waits. Then when the crash comes and everyone else is panicking, he deploys. Stage 1, accumulate massive cash while selling stocks. Stage 2, sit in cash while the market rises without him. Stage 3, deploy at the bottom when blood is in the streets. Right now, in November 2025, Buffett is deep into stage 1 with $325 billion. That's 2.7 times larger than his 2019 position. And if the pattern holds, if history repeats the way it has twice before, the crash is coming within 12 to 24 months. And Buffett will deploy that $325 billion at 40 to 60% discounts, while everyone else is broke and terrified. Let me show you exactly what Buffett is doing, why the $325 billion position proves he sees a crash coming, how the three-stage pattern worked in 2000, 2008, and in 2020, and what happens next. Because this is the clearest signal in the market right now. The greatest investor of all time is screaming that stocks are overvalued and a crash is coming. The only question is whether you're listening. Let's start with 1999, because this is when Buffett first executed the three-stage pattern at scale. By 1999, the dot-com bubble was in full mania. Internet stocks with zero revenue were trading at billions in market cap. Pets, Com, Webvan, eToys, companies that sold products at a loss and called it growth. The Nasdaq had tripled in 3 years. Everyone was getting rich. Day traders were quitting their jobs to trade tech stocks full-time. Warren Buffett was not participating. He owned 0 internet stocks, 0 tech startups, 0 dot-com companies. His biggest holdings were Coca-Cola, American Express, Gillette, old economy stocks, boring stocks. And for this, he was mocked. Barron's ran a cover story in December 1999. What's wrong, Warren? The article detailed how Buffett had underperformed the S&P 500 for 5 consecutive years. His worst stretch ever. Technology was the future. Buffett was a dinosaur. He'd lost his touch. At the Berkshire Hathaway annual meeting in 1999, shareholders questioned whether Buffett should retire, should step aside, let someone younger who understood the internet take over. Buffett's response was simple. I don't invest in things I don't understand, and I don't understand how these companies make money. This was stage 1. Buffett wasn't buying the mania. Instead, he was accumulating cash. By the end of 1999, Berkshire held approximately $25 billion in cash and treasury bills, the largest position he'd ever held. $25 billion doing nothing while the Nasdaq soared another 85% in 1999 alone. The criticism intensified. Buffett was called out of touch, past his prime, doesn't understand technology. CNBC ran segments asking if the Buffett era was over. Investors pulled money from Berkshire to chase dot-com stocks. Buffett sat in cash. Stage 2, watching the market rise without him, missing gains, looking foolish, but waiting. Then March 2000, the bubble popped. The Nasdaq peaked at 5,048 on March 10th, 2000. Then it crashed. By October 2002, the Nasdaq had fallen 78%, from 548 to 108. Pets.com went bankrupt. Webvan went bankrupt. eToys went bankrupt. Hundreds of dot-com companies went to zero. The S&P 500 fell 49% from peak to trough. $5 trillion in wealth evaporated. Retirement accounts were decimated. Day traders went back to their jobs. The mania was over. And Warren Buffett, he deployed. Stage 3. Between 2000 and 2003, Buffett bought aggressively. He didn't buy the bankrupt dot-coms. He bought quality companies that had been sold off in the panic. He increased positions in American Express, Wells Fargo, and Coca-Cola at 40 to 50% discounts. He bought small cap value stocks that nobody wanted. From 2000 to 2003, while the S&P fell 49%, Berkshire Hathaway was up 10%. Buffett's cash gave him optionality. While everyone else was forced to sell or sit in losses, Buffett deployed capital at the best prices in a decade. By 2005, Berkshire stock had doubled from the 2000 lows. The cash position that looked foolish in 1999 was genius by 2003. The pattern was established. Accumulate cash when valuations are extreme. Sit in cash while the market rises. Deploy when the crash comes and prices are cheap. Stage 1, Stage 2, Stage 3. Now let's jump forward 8 years to 2007. The housing bubble was in full effect. Home prices had doubled in many markets. Subprime mortgages were being given to anyone with a pulse. Wall Street was packaging these garbage loans into 8AA-rated securities and selling them worldwide. Lehman Brothers, Bear Stearns, Countrywide Financial, they were printing money, or so it seemed. Warren Buffett was not participating in the housing boom. He wasn't buying mortgage-backed securities. He wasn't lending subprime. He wasn't investing in home builders. He was accumulating cash. By mid-2007, Berkshire Hathaway held $40 billion in cash and short-term treasury bills. This was a record at the time, larger than the 1999 position. And once again, Buffett was criticized. The market was at all-time highs. The S&P 500 hit 1,565 in October 2007. Housing was strong. The economy was growing. Unemployment was 4.5%. Corporate earnings were at records. And Buffett was sitting in $40 billion in cash, earning 4% in treasury bills, while the S&P gained 15% annually. Analysts said he was too cautious, too old, missing opportunities. Private equity firms were making billions leveraging up to buy companies. Hedge funds were making 20 to 30% annually, and Buffett was in cash. Stage 1 complete. Stage 2 beginning. Cash position held while markets rose without him. Then the cracks appeared. In August 2007, Bear Stearns announced 2 hedge funds had collapsed. Subprime mortgage defaults were spiking. The housing market was rolling over. By March 28, Bear Stearns was bankrupt, sold to J.P. Morgan for $2 per share. The stock had been $160 a year earlier. But the real panic came in September 2008. Lehman Brothers filed for bankruptcy, the largest bankruptcy in U.S. history. $639 billion in assets gone. The same week, Merrill Lynch was sold to Bank of America to avoid bankruptcy. AIG, the giant insurance company, collapsed and required a $180 billion government bailout. Washington Mutual failed. Wachovia failed. The entire financial system was on the edge of total collapse. The stock market crashed. The S&P fell from 1,565 in October 2007 to 66 in March 2009, a 57% collapse, and Warren Buffett deployed. Stage 3. In September 2008, at the peak of the panic, Buffett invested $5 billion in Goldman Sachs. He got preferred stock paying 10% dividends plus warrants to buy Goldman stock at $115. Goldman was trading at $125, down from $250 a year earlier. Everyone thought Goldman might fail. Buffett bet it wouldn't. In October 2008, Buffett invested $3 billion in General Electric on similar terms, 10% preferred stock plus warrants. GE was trading at $22, down from $42. The company needed capital. Buffett provided it at terms that guaranteed he'd make billions. In 2011, Buffett invested $5 billion in Bank of America. The stock was trading at $7, down from $55 before the crisis. Again, preferred stock plus warrants. These 3 investments alone, made during the crisis when everyone else was panicking, generated over $20 billion in profits for Berkshire. The $5 billion Goldman investment was worth over $10 billion by 2013. The Bank of America investment doubled. The GE investment returned 10% annually plus massive warrant gains. But it wasn't just those 3 deals. Between 2008 and 2010, Buffett deployed the entire $40 billion cash position into stocks trading at 40 to 60% discounts. He bought when everyone else was selling. He had capital when everyone else was broke or leveraged. From March 2009 to 2013, the S&P 500 rose 165%. Buffett's portfolio, deployed at the bottom with that $40 billion in cash, did even better. By 2013, Berkshire's stock price had tripled from the March 2009 lows. The pattern repeated. Accumulate cash before the crash, sit in cash during the mania, deploy at the bottom when others can't. Stage 1, Stage 2, Stage 3, and it worked again, just like it did in 2000. Now let's look at the most recent example, 2019. The market had been rising for 10 consecutive years since the 2009 bottom. The S&P 500 hit all-time highs month after month, the longest bull market in history. Valuations were extreme. The Shiller PE ratio was at 30, double the historical average. Margin debt was at record levels. Corporate debt had exploded. Warren Buffett was not buying. He was accumulating cash, again. By the end of 2019, Berkshire Hathaway held $128 billion in cash and treasury bills, the largest position ever at that time, more than triple the 2007 position, an absolutely staggering amount of money sitting idle, and the criticism came immediately. Buffett is hoarding cash while missing the bull market. He's too old to understand modern markets. Berkshire is underperforming because Buffett won't deploy capital. CNBC ran segments. Wall Street analysts downgraded Berkshire stock. Shareholders complained at the annual meeting. Buffett's response was the same as always. We don't see anything attractive at current prices. We're not going to buy something just to deploy cash. We'll wait for the right opportunity. Stage 1 complete. $128 billion in cash. Stage 2 beginning. The S&P continued rising through January and February 2020. Hit 3,986 on February 19th, 2020. New all-time highs. And Buffett sat in cash. Then COVID hit. In late February 2020, the pandemic started spreading globally. Lockdowns began, the economy shut down, and the market crashed faster than it ever had before. From February 19th to March 23rd, 2020, just 33 days, the S&P fell 35%, and Warren Buffett deployed. Stage 3. In April 2020, Buffett bought massive positions in 5 Japanese trading houses: Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo. These companies were trading at 6 to 7 times earnings, far below their historical averages. Buffett invested approximately $6 billion across these 5 positions. By 2023, those positions had doubled. The Japanese stocks rose 100 to 150%. That's $6 billion became $12 to $15 billion. In August 2020, Buffett invested heavily in Occidental Petroleum. The stock was trading at $10, down from $75 before the oil crash. By 2024, Occidental was trading at $60. The position was up 6x. He also bought Verizon, Chevron, and increased positions in Bank of America and Apple during the panic, all at 30 to 50% discounts from pre-COVID prices. From the March 2020 bottom, the S&P rose 100% by August 2021. Buffett's portfolio, deployed during the panic with that $128 billion in cash, outperformed. Berkshire stock went from $180 in March 2020 to $450 by late 2021, a 150% gain. The pattern worked for the third time. Accumulate massive cash when valuations are extreme. Sit in cash while the market rises and critics mock you. Deploy when the crash comes and blood is in the streets. Stage 1, Stage 2, Stage 3. 3 times. 3 decades. 3 completely different crises. Dot-com bubble, financial crisis, pandemic. Same pattern, same outcome. Buffett wins by having cash when others don't. So let's define the 3-stage pattern clearly, because once you understand it, you'll see exactly where Buffett is right now and what's coming next. Stage 1, accumulate cash while selling stocks. This is when Buffett sees valuations reaching extremes, when the Shiller PE ratio goes above 30, when margin debt hits records, when everyone is euphoric in buying. He does the opposite. He stops buying stocks. He starts selling positions. And he accumulates cash. The cash doesn't sit in checking accounts. It goes into short-term treasury bills, 3-month, 6-month, 1-year treasuries. These are as safe as cash, but pay interest. In 2024, they're paying 5%. So Buffett earns $16 billion per year on his $325 billion in cash. That's $16 billion in risk-free income while he waits for the crash. The key is, this isn't market timing. Buffett doesn't try to predict when the crash will come. He just knows that at extreme valuations, expected returns are low and risk is high. Stocks trading at 30 times earnings can't deliver good returns unless earnings double. And earnings don't double when the economy is already at peak employment and peak margins. So he moves to cash, not all at once, gradually, selling positions that have appreciated, taking profits, building the war chest. In 1999, he built to $25 billion over 2 years. In 2007, he built to $40 billion over 18 months. In 2019, he built to $128 billion over 3 years. And now in 2024, 2025, he's at $325 billion. The buildup took 4 years and is still growing. Stage 1 is complete when the cash position is at a record level, not just in dollars, but as a percentage of total assets. Right now, cash is 30% of Berkshire. That's the highest percentage in the company's 60-year history. This signals that Buffett is as defensive as he's ever been. He sees maximum risk in stocks and is positioned for maximum safety. Stage 2, sit in cash while the market rises without you. This is the painful stage. The stage where Buffett looks foolish, where critics say he's lost his touch, where shareholders complain, where the market continues rising and Buffett sits on the sidelines earning 4 to 5% in treasury bills while the S&P gains 15 to 20%. In 1999, Buffett sat in cash while the Nasdaq soared 85%. In 2007, he sat in cash while the S&P hit all-time highs. In 2019, he sat in cash while the market rose 30%. And every time, the criticism was intense. Buffett doesn't understand technology. He's too old. He's too conservative. The world has changed and he hasn't. CNBC runs segments. Analysts downgrade Berkshire. Retail investors sell Berkshire stock to buy growth stocks. This stage can last months or years. In 1999, it lasted 2 years before the crash. In 2007, it lasted 18 months. In 2019, it lasted 4 months before COVID. There's no way to know how long it will last, but Buffett doesn't care. He's not trying to time the peak. He's just waiting for the inevitable crash that always follows extreme valuations. Here's the key. During stage 2, Buffett is not hoping for a crash. He's not rooting against the economy. He's simply patient. He knows that valuations are mean reverting. Trees don't grow to the sky. Markets that rise far above historical averages always fall back. It's mathematical. It's certain. The only uncertainty is timing. So he waits, earns 5% on treasury bills, reads annual reports, looks for opportunities, and trusts that at some point, fear will replace greed and prices will collapse. Stage 2 is complete when the crash begins, when the euphoria breaks and panic sets in. Stage 3, deploy at the bottom, when blood is in the streets. This is Buffett's famous quote, "Be fearful when others are greedy. Be greedy when others are fearful." Stage 3 is when he executes that philosophy at scale. When the market crashes, when the S&P is down 30, 40, 50%, when unemployment is spiking, when banks are failing, when the media is running 24-hour economic collapse coverage, when everyone is terrified and selling, that's when Buffett deploys. He doesn't try to catch the exact bottom. He doesn't try to time the market perfectly. He just waits until valuations have fallen from extreme to reasonable or cheap, when the Shiller PE falls from 35 to 15, when dividend yields rise from 1.5% to 3%, when quality companies trade at 10 times earnings instead of 25. And then he deploys the cash, all of it, aggressively, into the best companies at the best prices he's seen in years. In 2000, 2002, he deployed $25 billion into stocks trading at 50% discounts. In 2008, 2009, he deployed $40 billion into Goldman, GE, Bank of America at crisis prices. In 2020, he deployed $128 billion into Japanese stocks, Occidental Chevron, at 40 to 60% discounts. The deployment typically happens over 6 to 18 months. He doesn't deploy everything in one day. He buys as prices fall, adds to positions as they get cheaper, averages in. Because he has massive capital when everyone else is broke or over-leveraged, he can negotiate incredible terms. The Goldman deal paid him 10% dividends plus warrants. The GE deal paid 10% plus warrants. These were deals only available to someone with billions in cash during a crisis. After deployment, stage 3 is complete. The cash is gone. The portfolio is loaded with stocks bought at crisis prices. And then Buffett waits for the recovery. The recovery always comes. Markets always recover. The S&P has never failed to make new all-time highs eventually. It just takes time. From the 2000 bottom, the recovery took 5 years. From the 2009 bottom, it took 4 years. From the 2020 bottom, it took 18 months. But Buffett doesn't need the recovery to be fast. He's patient. He owns quality companies with strong cash flows bought at cheap prices. They pay dividends. They compound. And when the market recovers, his portfolio soars. That's the 3-stage pattern. Accumulate cash when valuations are extreme. Sit in cash while the market rises. Deploy when the crash comes. Simple, proven. Repeated 3 times over 3 decades. Now let's look at where Warren Buffett is right now in November 2025. Because the position he's built is screaming that he sees a crash coming. And it's bigger, more extreme, and more defensive than any position he's ever held. As of Q3 2024, Berkshire Hathaway holds $325.2 billion in cash and short-term treasury bills. Let me put that in perspective. That's larger than the GDP of Ireland, larger than the market cap of Tesla, larger than the entire economy of Hong Kong. $325 billion doing nothing but sitting in treasury bills, earning 5% interest. That represents 30% of Berkshire's total assets. Let that sink in. 30%. The most cash-heavy Berkshire has ever been in its 60-year history. More than 2007, more than 2019, more than any point ever. And Buffett isn't just accumulating cash passively, he's actively selling stocks to build this position. Let me show you what he's sold. In 2024 alone, Berkshire sold $134 billion in stocks, the largest selling year in the company's history. What did he sell? He sold 50% of his Apple position. Apple was Berkshire's largest holding, representing over 40% of the equity portfolio. Buffett held $170 billion in Apple stock at the peak. He sold $75 billion worth, cut the position in half. The media explanation was taxes. Apple's stock price had tripled. Buffett was taking profits and paying capital gains taxes now because he expects tax rates to rise. That's the official story. But here's the problem with that explanation. Buffett has held Coca-Cola for 36 years, American Express for 30 years. He's never sold either position for tax reasons. He famously said, "Our favorite holding period is forever." He doesn't sell winners, unless he thinks the price is too high and the risk-reward is terrible. Then he sells, and he sold 50% of Apple in 2024 because at 200 plus per share, trading at 30 times earnings, the stock is overvalued. So he's taking profits and moving to cash. He also sold significant portions of Bank of America stock throughout 2024. Bank of America was his second largest position. He'd held it since 2011. He sold billions in 2024. Again, the explanation was rebalancing. But Buffett doesn't rebalance. He holds forever unless he thinks it's overvalued. He sold his entire position in several smaller holdings, sold airlines completely after COVID, sold pharmaceutical stocks, sold various financials. Everything's sold. Cash accumulated. And what is he buying? Almost nothing. In Q2 and Q3 2024, Berkshire's stock purchases totaled under $5 billion. Meanwhile, he sold $134 billion. That's a 27-to-1 sell-to-buy ratio. He's not even pretending to find attractive investments. He's in full cash accumulation mode. The only thing he's buying is treasury bills, short-term government bonds yielding 5%. That $325 billion in cash earns $16.25 billion per year in interest. That's $16 billion in risk-free income while he waits. Now, why is Buffett doing this? What does he see that justifies the most defensive position of his career? He sees valuations at extremes. The Shiller PE ratio, Buffett's preferred valuation metric, sits at 36. The historical average is 16. Stocks are trading at more than double fair value. The only times the Shiller PE has been higher were the dot-com bubble in 2000 and briefly during COVID in 2020. Both were followed by crashes. The Buffett indicator, total market cap to GDP, is at 185%. Above 150% is bubble territory. We're at 185%. This means stocks are valued at 85% more than the entire economy produces. That's unsustainable. It has to mean revert. And mean reversion from 185% to 100% means stocks fall 45%. He sees corporate debt at record levels. U.S. corporations owe $12 trillion. Much of this was borrowed at low interest rates between 2009 and 2021 when money was cheap. But those bonds are maturing. They need to be refinanced. And current interest rates are 5 to 7% instead of 2 to 3%. This means companies that could afford debt service at 3% interest can't afford it at 7%. They'll default. He sees commercial real estate collapsing. Office buildings are 40% vacant. Remote work is permanent. Properties bought with 3% mortgages can't be refinanced at 8% rates. Defaults are accelerating. Regional banks holding these loans are in trouble. Buffett, as someone who held massive bank stocks, sees the loan books. He knows the loss is coming. That's why he's been selling Bank of America. He sees the federal deficit at $2 trillion annually, the debt at $38 trillion, interest payments at $1.2 trillion per year. This is unsustainable. The government will either print money, causing inflation, or cut spending, causing recession. Neither outcome is good for stocks. He sees margin debt near record highs, over $900 billion borrowed to buy stocks. When the market turns, margin calls will force selling. That selling will cascade. Buffett knows this accelerates crashes. He sees insiders selling at record levels. Bezos sold $13 billion in Amazon. Zuckerberg sold billions in Meta. Jamie Dimon sold JP Morgan stock for the first time in 19 years. Nvidia insiders dumped $700 million. The smart money is exiting. Buffett is doing the same. And most importantly, he sees no attractive investments. In the Q2 2024 shareholder letter, Buffett wrote, "We prefer owning cash equivalents over stocks at current prices." That's the clearest statement of his view. Cash earning 5% is better than stocks at current valuations. That's stage one thinking. Maximum defensiveness. So where's Buffett in the three-stage pattern right now? Stage one is complete. He's built $325 billion in cash, the largest war chest ever assembled. He's sold $134 billion in stocks in 2024 alone. He's positioned for maximum defensiveness. Stage one, done. Stage 2 is active. He's sitting in cash while the market continues to make new highs. The S&P hit 6,000 plus in late 2024. Berkshire sat in cash. Critics are already starting. Buffett is too old. He doesn't understand AI. He's missing the boom. This is the classic Stage 2 criticism. And Buffett is ignoring it, just like he ignored it in 1999, 2007, and 2019. Stage 3 is coming. When the crash happens, Buffett will deploy that $325 billion at 40 to 60% discounts. He'll make deals like Goldman in 2008. He'll buy quality companies at crisis prices. And he'll generate returns that will make the next decade incredibly profitable for Berkshire. The only question is timing. When does Stage 2 end and Stage 3 begin? When does the crash come? Based on history, it's typically 12 to 24 months after peak cash accumulation. Buffett hit $128 billion in late 2019. COVID crashed the market in March 2020, 4 months later. Buffett hit $40 billion in mid-2007. The market crashed in October 2007, 15 months later. Buffett hit $25 billion in 1999. The market crashed in March 2000, 4 months later. If the pattern holds, Buffett's $325 billion position, built throughout 2024 and into 2025, suggests the crash comes in late 2025 or 2026, maybe as late as early 2027, but likely within the next 12 to 24 months. The setup is identical to the previous 3 times. Extreme valuations, record cash position, critics saying Buffett is too old and missing the boom. All that's missing is the crash. And the crash always comes. Let me be absolutely clear about what this means. Warren Buffett, the greatest investor of all time, the man who turned $100 into $140 billion over 60 years, the man who's never had a losing decade, the man who has perfect visibility into corporate earnings, bank loan books, economic data, and market valuations, is positioned more defensively than at any point in his career. 30% of Berkshire is in cash. He sold $134 billion in stocks in 2024. He sold 50% of his largest position, Apple. He's buying nothing. And he's sitting on $325 billion in treasury bills, earning 5% while he waits for the crash. This is not a minor position. This is not a temporary pause. This is the clearest signal Buffett can send without literally screaming, the market is going to crash. And he's done this exact pattern 3 times before. 3 times he's built massive cash positions when valuations reached extremes. 3 times he sat in cash while the market rose and critics mocked him. 3 times the crash came, and 3 times he deployed at the bottom and made tens of billions. 1999 to 2000, $25 billion in cash. Dot-com bubble crashed, deployed at the bottom, doubled his money. 2007, too late, $40 billion in cash. Financial crisis hit, deployed into Goldman, GE, Bank of America, made $20+ billion. 2019, 2020, $128 billion in cash. COVID crashed the market, deployed into Japanese stocks, Occidental, Chevron, doubled his positions. Now, 2024, 2025, $325 billion in cash. The pattern is repeating. The crash is coming. And Buffett is positioned to deploy at the best prices of the decade. The 3-stage pattern is absolute. Stage 1, accumulate cash when valuations are extreme. Stage 2, sit in cash while the market rises. Stage 3, deploy when the crash comes. Buffett is in late Stage 1, early Stage 2. The cash is accumulated. The market is still rising. The critics are starting to appear. And the crash is coming. You cannot match Buffett's position. You don't have $325 billion, but you can recognize the pattern and position accordingly. If Buffett, with all his experience, all his data, all his insights, is 30% in cash, maybe you should be too. Not 30% if you're young and can recover from crashes, but 20%? 25%? Enough to preserve capital when the crash comes and enough to deploy at the bottom. The crash will happen. It always does. Valuations at 2x historical averages always mean revert. The only question is timing. And based on Buffett's position, based on the pattern from 1999, 2007, and 2019, the crash is likely within the next 12 to 24 months. Maybe late 2025, maybe 2026, maybe early 2027, but it's coming. And when it comes, when the S&P falls 40 to 50%, when everyone is panicking and selling, when the media is running 24-hour collapse coverage, Warren Buffett will deploy $325 billion at crisis prices. He'll make deals that guarantee billions in profits. He'll buy quality companies at half price. And he'll compound that capital over the next decade. The billionaire exodus is real. Bezos sold $13 billion. Zuckerberg sold $50 billion. And Jamie Dimon sold for the first time ever. And Warren Buffett built $325 billion in cash. They see what you don't. They have access to data you don't. And they're all doing the same thing, exiting stocks, accumulating cash, waiting for the crash. The three-stage pattern has played out 3 times over 3 decades. 3 different crises, same pattern, same outcome. Buffett wins. Stage 1, accumulate cash, done, 325 billion. Stage 2, sit in cash, active, happening now. Stage 3, deploy at the bottom, coming. 12 to 24 months. The pattern is clear. The position is record-breaking. The crash is coming. If this showed you a pattern you didn't see before, if you understand now that Buffett's $325 billion cash position is the loudest signal in the market, subscribe, because over the next 12 to 24 months, I'll track Buffett's every move. When he stops selling, when he starts buying, when stage 3 begins. This is not financial advice. This is pattern recognition. The pattern has worked 3 times. It's working again. Warren Buffett is screaming that the crash is coming. The only question is whether you're listening. 3 stages, 3 historical examples, $325 billion in cash. The crash is coming. Position accordingly.